All right. Welcome everybody to Midas Investing Live. Happy Sunday afternoon to everybody out there. Let's see if the stream actually wants to work this week. Apologize to anybody that was potentially looking forward to last week's show, but having a whole lot of technical difficulties. And I've tried to address some of those problems this week, but I didn't really have a whole lot of time to do too big of changes. So I really was just doing some minor diagnostics on my computer and my software. Um, but there's some issues with some of the programs on my computer and them leaking out memory pretty significantly to other parts of my computer. So kind of creating some RAM issues. But to be honest, at some point or another, I probably just need to get a new computer, which I've been putting off for quite a long time. And maybe I'll get around to this holiday season finally. But either way, it looks like the stream is working for now, at least. Hopefully, I don't do anything too crazy to overload it. I mean, like I said, it wasn't more of some other programs on my computer that I think were the biggest root cause of the issue, but at the same time, doing too many things on my computer simultaneously, which I pretty regularly do a lot of things at the time, definitely starts to take a toll on it. So we'll see. We'll see how things go here today. Like I said, everything looks pretty good on the technical end here right now. So hopefully it stays that way. So anyway, we will try to talk a little bit about the subject I was kind of planning to talk about last week, a little bit at some point here, but trying to kind of talk about some other things that happened this week as well. We had some more companies reporting, more up and downs in the market in general. Uh, Taking a look right here, for example, one particular company that a whole lot of action and discussion happened this week on was Advanced Auto Parts. They had their earnings report come out, which was pretty significantly worse than expected in terms of the actual analyst estimates of for the earnings in particular. The sales were actually pretty decent. I actually didn't remember seeing what the analysts were expecting for sales in particular, but either way, they had growth, mild growth in their sales, both in just total nominal terms, but also on same store growth. So that was pretty good. It was mostly the bottom line that everybody was talking about. But like I said, we'll talk about that a little bit more particular here in a minute. I was definitely asked behind the scenes a few times about from some viewers what my thoughts were on it, and I gave some comments on YouTube about it, but I figured I would kind of go through some of the changes that I've made to my valuation for it because I definitely believe that at this point it merited some serious changes compared to the valuation I put out on my video. Because, well, I definitely think I was just being a little too optimistic in terms of how quickly they were going to turn things around. But there was also some good things to be said in that earnings report, so we'll get to that at some point. Coming down, in general, you can kind of see how the last couple weeks have been in terms of the year to date portfolio return chart right here. Still outperforming the small caps by somewhat of a margin. What we got, see, small caps are now at 3 to 4%, about 3.5% on the year in total returns, whereas my portfolio is at around 8.5%. But the S&P 500 in total returns is at a little over 19%. So still significantly underperforming the S&P. We have narrowed the gap a little bit compared to the max distance that we had with the S&P at some points here, but only by a couple percentage points. So nothing super major there. Would definitely like to see more closing of the gap here. Coming down to the total return chart, you can see there's some issues going on with the way it's feeding the small cap index in here right now, so you can't really see that too much. But either way, you can see my total returns over time. I need to fix that at some point when I'm off stream. But we had some movements up and down in a few of the other companies in the portfolio. Um, uh, in particular, InMode has definitely made up a lot of the lost ground compared to the bottoming of how far down I was. I was down over 25% at one point on InMode, and it's kind of closed the gap to about half that at this point. Somewhat similarly for Interfor, I was down over 30% at one point, and that's definitely started to close the gap. It's now around 20% a little bit. Still a long way to go to get up into total territory, but definitely curious to see about those. Interfor is one I haven't talked about in quite some time, partially because with my newer allocation system, I was definitely already well within the range of it, so I haven't been able to buy much of it recently, so I just haven't thought about it too much. I'm kind of just waiting for the longer term thesis to play out. That being that it's a lumber producer, a forestry company, and lumber prices are still pretty depressed compared to where they were at some of their peak levels. But I'm not necessarily super concerned about that. I kind of look at that as just something that you have to sit through, especially given the tightening cycle that we're currently in with interest rates. Interest rates may have already peaked, but may also not have already peaked. Either way, all commodity prices are likely to stay relatively depressed compared to some of their potential levels until that peak has reached its point and we start to go down into at least somewhat of an easing territory. Maybe not into like full on easing in terms of the central banks, but at least whenever we reach our peak levels in terms of interest rates, we'll start to see things turn around there. I have some other comments on that subject a little bit. Like I said, one of the things I was planning to talk about last week was some stuff related to real estate. So we'll talk about that here in a minute. But the dynamics of the real estate market is definitely some of the things that makes me think that lumber will eventually have its day. So I'm not super concerned about that. I definitely just wish that maybe I had waited a little bit longer to allocate as much as I did to that company as well as some others. And that same attitude applies to Advanced Auto Parts, where I definitely had more bullish estimates on it in terms of how much it could make lost ground in terms of coming back to some previous levels. And as I said, I've kind of reworked some of the thoughts around that one as well. But that's often the situation for a lot of my companies. I often get a little too excited initially, and then often find myself more allocated than I would like earlier on relative to some of the downward levels it often comes to. As I often say, you have to be down on something before you're likely to be up on something. Or at least that's definitely my experience as somebody who likes to buy things that are down rather than, companies that are running in a bullish momentum upwards. Very few examples of companies where I think I was very, very careful and measured in a very, very smart way. I often find that early allocations to be some of the bigger mistakes I make. A good example of one where I think I did actually a really good job in regards to that was actually Generac. Generac, I was very, very careful and very, very hesitant to start adding to that position as I was starting to build that position. And then we had some serious drops in Generac, and then that really, really paid off that patience because I was able to add much more at those lower levels. And then once we got the bounce back, I'm already into positive territory with that one. So it's definitely good to see. Sometimes if you and learn from your mistakes a little bit. And that's also somewhat a result of the newer allocation system, as I've been talking about as well. Generac was a position that was started basically around the time that I started the new allocation system, whereas AAP was a position I had already started to allocate to a little bit before I developed the new system, and that definitely applies to Interfor as well and a few of the other companies. But like Generac and InMode are two companies where I think I've been a little bit smarter about my early allocation levels in regards to that. PayPal has been okay, but I definitely started allocating a little bit sooner on that one as well. But that one, I just think I have a little bit more potential upside to in that regard. But either way, I like to mark here in the total returns ones, basically companies that are either up or down 25% or more is what the things are marked green and red, just in case you're ever wondering like what's the difference between the color coding here. It's just that's what I when I would say something has reached sort of a significant up or down level. So obviously with FG being well over 100% in total returns, FNF over 50% in total returns, and then SWBI, oh, actually, it looks like it's dipped below 25%, but it's not an automatic color shading. So I guess that one shouldn't actually be green. But either way, up over 20%. And then AAP down 26%. Um, uh, Spirit Airlines down 36%, though that is not a value position. That's more of a merger acquisition arbitrage play. I don't really like using the word arbitrage attached to those strategies, but that's the term everybody likes to use. And then, which so it doesn't really shock me that I'm too down on that, especially given how unvaluable the company is if it is unable to get a deal. But I've also gone back and forth on just how much value to assign to that. I'm trying to be super conservative with my no deal estimate for Spirit Airlines, but at the same time, it is a very risky company due to its high debt levels and low margins and things like that. So there's those things to take into account. But I don't think that the deal for that one is entirely off the table at this point. I know a lot of the market in general is actually not very optimistic on that deal currently. I would say. But I still think that there's a decent chance that the deal goes through. And then I would say that the reward for such a deal is pretty disproportionate. So that's part of the reason I'm still holding it. But it is also an incredibly small position in our portfolio. So that's one of the reasons I'm right here. Very, very tiny percentage of my portfolio is assigned to that particular holding, 0.2%. So it's very, very small amount of money, and I haven't added new capital to it. I'm just not selling it, even though I'm significantly down. And then my put options, which I'm always down on in general, because those are not really designed to do well unless the market's taken some significant dives over a pretty short period of time. It's a portfolio insurance, effectively. But either way, so that's kind of a pretty good rounding update on the portfolio in general. Our cash levels are a little bit above our cap level that we're trying to target for. So we're still trying to assign some more capital to some more positions. But in the last week, I didn't really add too much to too many positions. I added a little bit of PayPal at the start of the week before we had the CPI report, and then that ended up being a relatively good choice, I think, because PayPal definitely had a good day along with a lot of the other companies after the CPI report came out. I didn't pull up the CPI data, but I will say that I do think the market is, once again, I know I've said this 100 times, but getting a little bit ahead of itself in terms of thinking that inflation is a dead animal at this point. And I think that CPI report did a good job of kind of confirming those thoughts in my opinion as well. Um, Given that it's true the headline year over year number came down and the month over month number was lower than expected, and that's partially what how we got where we got with it. But the core levels are still relatively high, and then there's a variety of dynamics in the market, in my opinion, that makes it so that it's unlikely that we're going to have major drops in the short term or even really the midterm, and that we actually have over the midterm to the long term a lot of backlog essentially to some parts of the calculation of the CPI index, which makes me believe that essentially there's a whole lot of significant increases in certain sections of the CPI calculation that are basically baked in for years to come. In particular, I'm talking about rents, which I guess this is a pretty good way to segue to the small amount of discussion that I was going to talk about last week. Like I said, that I will talk about now, which was in regards to real estate prices and rent prices and how they are related to each other. So if I come over to the Federal Reserve website and pull up this chart here, in the blue in the background, we have the Case-Shiller Home Price Index, which is pretty much the gold standard in terms of a housing index here in the United States, going back to 1988. I wish we had this index going back even further. And that would be really, really great if I could get like the 60s and 70s for this number, so I could show what the patterns sort of looked like even prior to the great inflation of the 70s and early 80s. But either way, we have it starting kind of towards the end of said great inflation, and then through the 90s, and then most recently, you can see obviously the housing index peaked around like 184 or so in 2006, and then it had its major declines due to the great financial crisis and the housing bust, all the way down to 136, which is a pretty significant decline. Let me think, like in my back of my head right there, that's like 20 to 25% of a decline on a national average, which is pretty significant. So obviously, being an average, there was going to be some locales, some cities, some metropolitan areas where they were declines were more like 50%, and then other ones that were more like 10 to 15%. So getting an average of 20 to 25% is pretty significant. And then honestly, more curiously, is paying attention to the run up in that, when, for example, the policies that essentially helped to start to drive the housing boom in the first place, which included some government regulatory changes and programs put in place in the mid 90s to kind of like help start some of that, which basically started to incentivize some of the massive overselling to um, uh, uh, less less privileged households, and in such a way that they were essentially starting to rack up large amounts of debt in home ownership in ways that were basically irresponsible, and the banks were essentially incentivized to do this through the mid to late 90s, and then as well as in the early 2000s up through the aughts, we had major declines in interest rates and keeping them in particular suppressed below inflation levels, done by Federal Reserve uh, Chairman Alan Greenspan, who was heavily responsible, in my opinion, for the housing boom and subsequent bust. So a lot of those, like I said, we basically had a long period of time of well over a decade of poor policies that essentially helped drive this boom in the first place, and that boom was inevitably going to lead to a bust. That's the thing, is a lot of people tend to focus on, oh well, what caused the crash. This is true with stock market crashes as well as it is with a real estate crash. But when people tend to look at crashes, they tend to look very recently, very short term, in like the year or two before that, rather than thinking about like what caused the preceding boom in the first place. Because you can't have a crash if you don't have a boom to begin with. It's like usually there's poor allocation decisions that are made in the boom phase, and those allocation decisions are being caused by poor policies or poor future guidestones to what might be happening in the future. Driven, it can be done privately or publicly, being the causes of these things. But the point is there's usually poor decision making long before the bust that essentially makes the bust inevitable. And so that's what I would say is definitely true of this one right here. Anyway, enough history about the GFC. But the point is, I bring that stuff up because obviously we have this huge run up and boom in real estate prices. We had a nice kind of pretty steady uptrend through the late aughts up through 2020 or so, but then post 2020 we had a huge run up. And the reason why I bring up those earlier comments about the GFC is to say, well, I mean, we have lots of reasons of to believe of why we got such a crazy run up here, which has to do largely with huge amounts of money printing, low interest rates, and then other policies that incentivize the taking on of more real estate debt as well. So there's other things similar in that vein, though it is a very different times as well. So I wouldn't necessarily say that we're going to get the same type of bust. And that's one of the reasons why I even brought this chart up in the first place, is to actually make the argument for why I don't think that we're necessarily going to see a huge real estate bust this time around, despite the huge run up in prices. We might just see a little bit more of a steady leveling off, or even just a slowing down in the rate of increase to that. So I've talked entirely this entire time essentially about the blue line, like I said. So let's talk about the red line. The red line is the same index, but then divided by the consumer price index for rent of primary residences. So this is essentially the rent section of the consumer price index. And then we have it essentially divided into that same housing price index, which then becomes essentially a measuring multiple of housing prices to rental prices over time. And I bring that up because you can see, for example, in the mid to late 90s, when that rate started to really pick up, and then eventually at some point it crossed over the point of the housing index. Though, like I said, the absolute value of said ratio doesn't necessarily matter. I have the ratio here on the right, while the index number is here on the left. And then eventually it reached a peak basically at the same time the housing prices reached their peak, and then the ratio started to drop pretty precipitously. And so the ratio itself, when it's dropping, essentially that means that housing prices are coming down much faster than rent prices. And then whenever it's going up, that means rent prices are going up faster than housing prices. Okay, and so that's kind of the idea of it. But like I said, it's about, or housing prices are going up much faster than rent prices. I reversed that, the upper trend there. It's not meant to be reversed. Like I said, housing prices to rent prices. So the idea is that whenever the ratio is high, that means homes are very expensive relative to rents. And whenever the ratio is very low, it means home prices are cheap relative to rents. In fact, if you were essentially to gear your entire portfolio around real estate, one argument you could make, this is almost like you can almost think of this as like a P ratio of sorts. Not actually a P ratio because it's not about earnings, and there is similar type measures for real estate, like the cap rate is effectively an inverted PE ratio, an earnings to price ratio, so to speak, for real estate. Though it's still not exactly earnings to price ratio. It's actually still more of like an EBIT ratio or an EBITDA ratio than an actual earning. But still, the idea is that you could buy real estate when this ratio is low. You could sell it when it's high and then go rent. And that's basically the argument. The argument is that whenever the ratio is way up here, it's actually far more incentivized to be renting than you are to be buying, which I do think is funny, especially in the most recent couple of years, because you hear people complaining about rental price increases. But the thing is I just think they don't understand how these dynamics work. They don't understand how home ownership works and the cost of home ownership. So a lot of people, I think, fail to understand when real estate is actually a terrible thing to be investing in, and when renting actually becomes a pretty decent bargain relative to the home ownership. Because nothing's in a vacuum. It's like, yeah, sure, rent prices have gone up, but how much of housing prices gone up instead. That's kind of the alternative here. And of course, most people get upset about that factor to a certain extent because they think, well, I could have been gaining all of that housing price increase, but uh, that's not necessarily the case. So if I come over here and I change the index from like the actual index number itself to instead show the percent change from a year ago, so we get like a year over year change to it, and then that line changes, and like I said, the percent change is now still here on the left. It's interesting because now you can sort of see how well these things line up with each other, even more so to a certain extent. And you can see also how one of them precedes the other. So housing prices start to reach their year-over-year declines well before that ratio starts to significantly decline, which shows that even when housing prices come down a little bit, rental prices will likely still keep going upwards because they're you always playing this like catch-up game, and that kind of depends on how big the gap got between the two significantly over time. And then you can sort of see similarly that we had a huge gap in the 2012 to 2014, 2015 kind of time frame. The gap started to narrow a little bit in some of the preceding years before 2020, and then they actually started to move up pretty significantly together. But like I said, the ratio itself isn't necessarily what matters. It's still more about the difference between it. But either way, you can see, for example, that we finally did reach a point where the year over year housing prices did start to decrease, but it was just barely on a year over year basis. So we had a handful of months where we had some declines there, and then it started to go up again, which we saw on the actual static index number itself. See the little peak drop down here, and then it starts to go up again. But indeed, housing prices have been going up again, and rental prices are continuing to go up and continuing to go up and continuing to go up. And the fact that the ratio isn't somewhere around this kind of midpoint, I don't know what the exact average is, but it looks, like maybe the average over this entire time series was maybe like 0.6, 0.65 or something, somewhere in that range is what it looks like the average was. So obviously with the ratio up here at like zero point 0.7, 0.76, 0.77 or something like that, we're still way, 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 way higher, which means that housing prices themselves should either be coming down significantly or rent prices themselves should continue to go up significantly. And so that I carry that over to, like I said, the topic I was saying before about CPI numbers. It's that the Federal Reserve, when they look at CPI numbers, they like to strip out food, strip out energy, and then when they're feeling real quirky, they decide to strip out real estate prices as well, and rent prices, because they're like, services less shelter. And I've often talked about that measure as being somewhat useful because services less shelter, in my opinion, becomes almost like a good gauge of where like the earnings growth for like median workers is, because that's like that's like wage growth itself, like the portion of CPI that becomes almost like the money that people are earning themselves from the products and services that they sell, because we're heavily a service based economy. So that's why I say services less shelter is a good proxy for that. And then obviously, not that many people necessarily work in food and energy and real estate relative to all the other services in the economy. There's a decent amount of people that work in energy, but the point is not that much necessarily in food generation or in shelter. And then the food and energy themselves is usually more of like commodity based prices, so that's usually more of an indirect proxy itself. But the point is either way, if the Federal Reserve is looking at this services less shelter number as like a good proxy for where core inflation is going to go over time, well, they may be very, very disappointed because the actual headline CPI number is probably not going to track that core number very well then, unless we have serious deflation in other categories. Because like I said, rent prices are continually going to be likely to go up over the next several years. So this is baked in. It's baked in based off this ratio. This ratio has to normalize at some point, and it's probably going to take a while to normalize. Even if we're arguing that it should normalize at some level where it was at a midpoint only for maybe the second half of this graph, which is basically once the interest rates themselves had already reached much lower levels than they used to be, even then the average ratio is still only maybe in like 0.67, 0.68 kind of range, and we're still significantly above that. So the point is that which one do you think is more likely to happen? Housing prices come down significantly or rents go up significantly? My money's on rents. My money is on rents. So that's just what I think is likely to happen. Especially if, for example, like I said, housing prices have started to go up again. And so not only, like I said, does this connect to the CPI, because a solid 25% of the CPI is the imputed rent prices for homes. So that means that about a quarter of the CPI number has baked in significant gains over the next several years. We could still end up with lower inflation rates overall, the headline number could still come back down to that target of 2.5% or something, or wherever the Fed wants to make it get to for them to say that they're reasonably satisfied with where it's at. But the point is it would require much larger deflation in the other categories. And I just don't think that's super likely. We might see some deflation in some of the service based categories, but not necessarily in the commodity based categories. I think we already saw most of the deflation we're going to see in the commodity based categories over kind of like the longer term, coming down from the supply chain shocks. We might see shorter term bursts of deflation in those categories, but I think they're likely to then be rebounded by growth in those categories again. And then you don't really want to see too much deflation in the more of the service categories, because as I was saying before, that becomes almost a good proxy for wage growth. So that wouldn't be very good for all those workers in the first place. Um, as long as the demographic dynamics exist for real estate as they currently are, then and also as long as the monetary conditions exist the way they are, I don't think that we're necessarily going to see huge housing decreases. Which is another reason why, like, connecting to one of the other topics I was talking about Interfor and lumber prices. That's one of the reasons I am pretty bullish on lumber prices over the long run, and why I don't necessarily mind the languishing in that particular commodity based company that I have exposure to in that category. Because I do think that, yeah, it's been painful this year, in last year, and next year might even not be super pretty too. But I do think that at some point or another, that that whole category of lumber is going to really start to shine. So another piece of information I kind of wanted to talk about to kind of like buoy this opinion is the vacancy rates. This is a rental vacancy rates in particular. The blue line being for the United States as a total average. We do have this number going back to the mid 50s, which is nice. I like having a little bit of a longer term number to look at instead of just kind of like a more recent generation of numbers. So we can get an idea of kind of how those things can ebb and flow over time. And kind of ignoring the other lines, like I said, just look at kind of like the deep blue line that we have right here. You can see that, I mean, it's hard. I don't know exactly where the average is, but it looks like maybe the average is around 7.5 or something like that over time. So 7.5% of all rental properties that are listed as available for rent in the United States, about 7.5 of them will remaining vacant at any given point ever since 1955 up through the present. Pretty reasonably consistent. But we see some ebbs and flows. We saw some highs, 8.9 up here. We saw highs in the GFC of 11.1. So that, all the talk about so much real estate basically being vacant. Of course, this is the rental section of it. Keep in mind. But we still only got up to 11.1% compared to maybe an average of around 7 to 7.5, right? And then in the 80s, we saw lows, or 70s and the 80s, we saw lows of around 5.15% in the late 70s and 80s. And what was going on during that period? The Great Inflation. So coming back over to the more recent bouts of inflation, what lows were we getting down to? Oh, look, we were hitting the fives, 5.8, 5.6. Looks like it bottomed at like 5.6 in early 2022, first quarter 2022 or something like that. Has rebounded up to more of a 6.6%. So it's getting a little bit closer to the average, but it's still below average. And so think of it this way. It's like if rental properties are vacant less than they have been historically on average, well, then that means that demand for rental properties is relatively high. And as I was saying before, it should be. It should be, because rent prices are low relative to home prices. And so it's actually incentivized people to sell their home in order to go rent instead, because, and you might say, well, why would you do that? You're going to miss out on the capital appreciation of a home. It's like, well, historically speaking, the capital appreciation of a home isn't necessarily something that you really want to bank on, and really to overly be thinking of as like the reason for buying the property. The reason you buy the property is so that you can live in it. And then therefore, if you're living in it, you're giving up a significant portion of the incomes you could be getting from it from, say, renting it. And then you also do have to pay property taxes. You have to pay maintenance costs. And also, if you have a mortgage on the home, you also have to have significant amounts of insurance on said mortgage, for at least for the first several years. So the point is, a lot of people look at the mortgage costs and compare that to the rental costs, but really that's a mistaken way to look at it. The actual cost of owning a home is usually closer to twice whatever the mortgage cost is. That's kind of like a general rule of thumb. You might be able to get a little bit better than twice that. But and like I said, that's including some maintenance depreciation in there as well. That you may not be spending that money every year, but you don't really know when your boiler is gonna go bust. You don't really know when you're gonna have to replace your air conditioning unit. You don't really know when you're gonna need to have to redo the roof, right? The point is those things happen on a little bit less of a regular basis. But if you were to take all those costs and try to average it out, and include it with the property taxes, include it with the mortgage insurance and stuff like that, well, then when you're first buying a home, you should probably be thinking, well, could I afford it if it's twice the mortgage level? And then that starts to make the rental costs actually look far more appealing. But anyway, and you can see right here in the more short term, I did include also some major metropolitan areas that I was able to find this same ratio for. So let's kind of narrow in on when that section of the chart starts. In particular, I included California, New York, Texas, Florida, Arizona. So major metropolitan areas, especially some of the ones that have seen some significant growth for in terms of real estate and in terms of population and migration levels in the last several years. I could have argued about including some other ones as well, but these are the ones I chose to include. You can see the pretty significant differences here. There's some that have way higher rates. Unfortunately, that ratio only comes in every year for those ones, whereas we get it on a quarterly basis for the United States one. Could actually, let me just change the United States one to an annual so that it's a little bit easier to look at on the chart. There we go. Now I can pull it up and it pulls up like the box there with all of them at that point in time. But yeah, so you can sort of see that, for example, back in the late 80s, we had, what is this, Texas and Arizona and Florida had higher levels of vacancies relative to the United States in general, while California and New York had low levels of vacancies. You know, California and New York is generally thought of to be one of the places where it's hard to get real estate because of the high demand levels that exist there. And you can see that over time, yeah, I mean, that one is consistently below the average. Whereas you see, for example, Arizona has kind of moved a little bit below the line at some points, and then above the line again, and below the line, and then it was below the line for several years here, and then it's now just barely above the line. So obviously, it looks like Arizona's had a little bit more of an ebb and flow in terms of just how much demand it has relative to some of the other major metropolitan area states that I included here. And then while we also have, what was it? Florida is a little bit more consistently above, but it's kind of hit that line a few more times as well. So yeah, you know, a little bit of an interesting ebb and flow to where you can see like which areas. And the reason I wanted to show that in particular compared to the United States is to show sort of what I was talking about in terms of that housing index, where it came down 20 to 25% on a national average. But there were some locations that had housing prices like 40 to 50% down during that same period of time, and other places that only had like 10 to 15%. So it's one of these things where it's like real estate, real estate, real estate, location, location, location. It's very, very localized. It's very much about the region that you're in. And like I said, one of the major factors you often want to take into account with this is migration flows, not just the most recent migration flows, but that is something you want to pay attention to, but also want to think about future migration flows too, because wherever the people are going, that's where real estate is likely to become high. But yeah, so the reason why I bring this up, though, like I said, is to kind of show that rental vacancies are still relatively low compared to their longer term averages. And that's while the housing to rental price index is relatively high, which incentivizes rental buying rather, or not necessarily buying, renting, you know, rental leasing more than actually buying property. So the market dynamics suggests that people should be renting more and more and more in order to equalize this. But the demand is actually still relatively high because people have already been trying to do so. So essentially, what that shows is that there's not necessarily enough rental properties available for all the people who want to rent. And of course, a lot of people then try to make an argument that, oh, well, there's a whole bunch of investors or hedge funds or institutionals or whatever that are holding all of these properties back, and they're just trying to take advantage of the situation. It's like, well, you can nix that idea from your mind too, because that doesn't really make much sense. Like, as I said before, there's depreciation costs, there is insurance costs, there is taxes costs. There's a whole lot of costs to owning a property that you don't make up just from capital appreciation. You have to be able to sell the property in order to capitalize on that. So it's actually very, very costly to hold onto a property without it being filled by somebody. That's not really a very good investment decision. So institutions aren't generally really doing that. And a fun fact, I was also looking on this earlier. BlackRock, for example, is one of the companies that is often slated as being behind all of this. It's basically a conspiracy theory. But if you look, BlackRock is pretty upfront that they manage about 120 billion dollars in real estate in total for their clients. That's the money that they manage, not, you know, not even what they own in particular. But what's managed for their clients is about 120 billion dollars in real estate. There's about $80 trillion in privately owned real estate in the United States. 80 trillion. Do the math on that. That's like 0.1%. So BlackRock BlackRock manages about 0.1% of the private real estate in the United States. I think it's hard to argue that they have basically anything more than the most negligible of effects on all of these situations. The real thing is that we need more building. We need more property building. And what do you need for property building? Lumber. Coming back around, like I said, to the lumber producing as an interesting category in my opinion. But also you need other things too. You need lots of other equipment that goes into the home building process. You need lots of the products that goes into homes as well, which is one of the reasons like that as an investment category is definitely one of the areas I've been trying to focus lots of attention on. So anyway, that's kind of a good summary of all of my kind of thoughts around real estate. Like I said, how that relates to inflation, how that relates to the lumber industry, that relates to also some of the other companies that I've been trying to pay a little bit more attention to. I will say, coming over here to the uh, the value dashboard, we have some significant movements up and down on some of the companies over here. One of the companies that I and some of the other major viewers of the channel I've been chatting with in the Discord pretty regularly. Which, by the way, if you're watching right now, live or on the replay, please like the stream. Please like the stream. Help us attract more viewers to the channel. Please subscribe if you're not already. Please hit that notification bell if you need to, and then also consider joining the Discord that I just mentioned. The free Discord is linked in the description below. It's also the pinned comment in the chat. You can find that there. But I'm in the chat. I'm in the live chat in the Discord at least twice a week, if not 3 or 4 times a week on a maybe a more exciting week. But usually about twice a week, I'll be in there for at least a couple hours. You're always free to hop in. You don't have to wait for me to hop in too. You could also just hop in and be there and maybe incentivize somebody else to get there. I've been trying to push people to join the Discord, but now I really would like to try to push people to maybe chat a little bit more in the Discord, not just in the text chat, but let's actually like maybe hop in the voice chat and start chatting a little bit more. Me and one other viewer pretty regularly are in there, like I said, about twice a week, and people are always welcome to join. So if you ever wanted to literally discuss something with me in actual voice, that is always an option. You can even message me if you wanted to try to schedule a particular time of a particular day if that helps suit you too. Because like I said, I'm in there just kind of like twice a week as sort of a form of habit, but that's really just when I have the most time available. But I have lots of other times available. I just don't necessarily think about it. So you could even message me on there and ask about it. But anyway, so the point is, as I was kind of bringing that up, is that one of the companies that me and this other viewer have regularly discussed in the last couple weeks is Encore Wire, which I did put a video out. If you haven't seen my Encore Wire video, go and check that one out. I'm definitely pretty proud of the work I did there. And I've adjusted it a little bit here and there. I think I pushed it up a little bit compared to the actual price that I had in that video. I think it was like 190, 195 or something as a fair value in that video, and I now have it up at like 201. And even then, I definitely think that it's very possible that I'm being conservative in pretty significant ways, just based off of the total demand that this company has potentially in the future going forward. This company produces wire products, as the name might imply, copper wiring as well as aluminum and copper based wirings. And that is a pretty significant factor for a lot of home building, as well as a lot of advanced electronics data centers and stuff like that. So they're, I think, a pretty significant company to help capitalize on the demand both for backlogs in real estate and home maintenance, as well as in the electrify everything theme that has been a significant topic of discussion here on the channel. But yeah, very, very interested in this company. Definitely been paying attention to it a lot in the last few weeks. Obviously, it's only just barely below my fair value here, so I haven't started to position it. I'm really kind of just watching it because I'm kind of hoping that maybe something exciting happens and we manage to maybe get something closer to my 25th percentile price, which is currently about $172. If it was for some reason dropped below 175, I probably would start a position. I would really, really like to have a position in this company because I do think it helps capitalize on those themes. One of the reasons I've been paying a lot of attention to it though is because this company is highly shorted. Highly shorted. It's I think it's like around 25% shorted right now, and it has like over 10 days on the days to cover ratio for the short level. So it's a very highly shorted company, and to be honest, I just don't understand why it's so highly shorted. It seems to me that the shorts have gotten really, really ahead of themselves on this one, and that over the last couple of years, because it's definitely been something that's been brewing over the last couple of years, this the shorting level, it seems to me like they're shorting it for all the wrong reasons. They're shorting it because it was at peak levels. They're shorting it because its short-term profit levels are expected to decline over the next few years, which they have. Since, like I said, the process kind of started a year and a half, 2 years ago when it was at its peak profit levels. And sure enough, they are significantly down from their peak levels now. But that's true for so many other companies. And in my opinion, they should be focused a little bit more on the mid to long term, where, in my opinion, the profit levels are likely to more or less balance off and start to level off. And then in the eventual future, will probably start to take off again. One other thing is that the company has been buying back its shares pretty significantly over the last 3 years, when previously it hadn't been doing that much. And a lot of people look at that and say, oh, well, it feels like they've been buying their shares at pretty high levels. And it's like, yeah, well, I think the rise in their stock price was appropriate, though. That was the stock, I think, being appropriately revalued to a higher level. And so I don't really look at the company as buying back their stock at overvalued levels. I look at the company as buying back their stock because they have excess cash flows and because they actually think of that as a better way to put capital forward rather than just allow it to build up on their balance sheet or to make less than efficient acquisitions or other capital expenses and things like that. So the company is very cheap on a multiple basis, and that's partially because it is expected to potentially have uh, further declines as well. Like, for example, you can see right here the trailing 12-month EPS is about $25, $26, and it says here the forward EPS is about $17. So you can see, like, yeah, there's decline in earnings expected in the short run, but the stock is already being conservatively valued at a 7.6 multiple. I believe, for example, on average, it's traded at like a 9 to 10 to 11 or so over time, the forward multiple being at 11. So, if you're looking on a forward basis, it's pretty reasonable to argue that it's kind of pretty appropriate in terms of its valuation right now. And so the way I kind of look at the balance between all of the buybacks being done on the company as well as the shorts is that the company is effectively buying shares from the shorts, which is very, very interesting because, when the shorts have to cover their short position in the future, whether they're profitable or not, they have to buy those shares out on the open market. And guess what shares are not going to be out on the open market? The shares that were bought back. So it seems to me like the shorts are setting themselves up for potentially a really, really bad time. As I said, it's possible that due to these earnings declines that maybe they'll see lower levels. Maybe they can get out at pretty profitable positions for that. But the other side of this is because, like, the way I'm kind of talking about this sort of seems to speak that there's potentially a squeeze in the works, or not in the works, but potentially in the cards for the future for Wire, which I definitely think is possible. I definitely think it's possible that at some point or another, the stock will start to spike up, and then the shorts will have to cover, which will cause more shorts to cover, and then we could get a little bit of a squeeze on this one at some point. But maybe that doesn't happen. Maybe it doesn't. Maybe the stock just comes down back to that, like I said, 175 level where I would like to enter the stock myself. And then at that point, the company is still buying back shares, and the shorts start to cover. And so one thing I like about short or companies that are shorted is that not only does it maybe create a potential squeeze in the future, but I look at that as more of like an unlikely thing that would be nice if it happened, but I'm not really counting on it to happen. But I actually like to buy companies that are highly shorted for another reason, which is I look at that as like helping to bottom the stock in the first place, because when the shorts do start to cover, that's like providing excess liquidity to the market. So I'm one of the people that doesn't really look at short sellers as like a negative thing in the market. I look at them as actually a service providing thing to the market, both in the sense that they uncover companies that are committing fraud or otherwise are way overvalued and need revaluing. And I consider that to be a good thing. I consider it to be a good thing when overvalued companies are brought back down to their appropriate levels. That's, in my opinion, a good thing. And then also at the same time, like I said, they provide liquidity when the rest of the market is trying to all sell and it's hard to find a buyer. Who is willing to buy? The person who already sold. So in my opinion, it's kind of nice if you see a company that has 25% shorted, because that means, yeah, maybe it does go to 170, maybe it goes 160, maybe it goes to 150, but at some point or another, it's going to bottom. And I think that shorts help create that bottom better than other situations. So been keeping an eye on this one. It would have been great if I was already in it. As it says right here, the 200-day moving average for them was at 174. So in some ways, it's possible I already kind of missed the chance there a little bit. But that is what it is. Uh, 174, 180, 193. It's in this nice uptrend as the kind of color coding from white to light to yellow goes, which is, by the way, what these colors mean if you don't remember. These are basically to give like a very quick showing of momentum in the value dashboard. You can kind of see based off of that pattern if it's moving to the left from white to light to yellow, that means it's in a bullish uptrend because it means that the 50-day moving average is higher than the 200-day moving average, and the current stock price is higher than the 50-day moving average. And then likewise, the other direction, if you see, like say up here with PayPal and Advanced Auto Parts, you can see it's going white to light to yellow to the right. Then that means that we have the opposite. In fact, we have a downward momentum where the 50-day moving average is lower than the 200-day moving average, and the current stock price is lower than the 50-day moving average. So bringing up Advanced Auto Parts, that's a pretty good way to segue into that part of the discussion, which we're going to go on to now. So, as I said, we had the earnings report from Advanced Auto Parts, and it's a bit of a mix of good and bad. I definitely am focusing a bit on some of the good parts because I think those good parts are very relevant to the longer term thesis for the company, and so I tend to focus more on those elements. But it was a pretty ugly an ugly quarter in the short run, in the short term. You're looking at like the most recent numbers themselves, and you're just looking at that. Yeah, it was pretty ugly, definitely pretty ugly. I didn't pull up the release to like go through some of the details, but I kind of remember a lot of them off the top of my head since I was, like I said, talking with a few people about it. But we did see growth on the top line. We did get a little bit of growth, not very huge growth. We're talking like 1.5% on the top line, but for this type of mature company, that's good. That's not, in a quarter, that's reasonable. We're not exactly expecting crazy revenue growths in any specific short run period. We're really just looking to make sure they're not losing ground, especially on the same store sales growth, which is good because that seems to be indicative of them actually getting better demand for them in particular rather than them just expanding their stores, because that's something that they do. But we did see a pretty nasty negative earnings number, so the bottom line was pretty atrocious. In particular, the gross margins had dropped very significantly from the same gross margins in the same quarter last year. And one of the major reasons that they list in that, other than just some transportation and supply costs being higher than they were expecting, but they were saying that the main driver of this was a revaluation of their inventories. So that's not very good. It's not something you want to see. Is the company saying, "Hey, we think our inventories are actually worth significantly less than we were carrying them for before"? Because yeah, it's not good. It means that essentially they were perceived to be higher profit at earlier points in time than they actually are, and rather than revising those previous quarters, they're essentially just taking the hit in the more recent quarter. That's not good. It's not what you want to see, but it's also not the type of thing that you're necessarily going to see over and over and over again. It's the type of thing where you make a big decision about that and then you move forward. And then I also want to line that up with the fact that one of the better things about this quarter is that they also got a new CFO pick that they announced. And they also had gotten their recent new CEO announcement as well in the quarter as well. And I'd also point out that the CEO only took effect basically like in the last month of the quarter itself. So the CEO himself isn't really the new CEO isn't really largely responsible, I think, for the results of this quarter, or really even the results of this year as it's going to be, because he'll basically only have about one quarter to have a huge effect on it. And so, and then likewise with the CFO, he had no effect on this most recent quarter. He was announced with the earnings report and is basically about to take effect, or I think maybe he already took effect this week. But either way, that's into the next quarter. So the point is that two of the top executive officers are not not really having a huge major effect on this quarter. It's mostly the other management. And then that inventory revision decision, like I said, it's sort of being a very common kind of one-off uh, acknowledgement of your mistake type move. I look at this as almost like them potentially trying to set up the new management with a cleaner slate, so that they can kind of move forward and the company can move forward and it can start to do better. So it's one of these things where it's like I do think that was maybe sort of a tactical choice to choose to do that this quarter. I mean, it's something they would have had to do eventually, one way or the other, that you could have maybe um, argued and moved it around a little bit, or maybe even tried to smooth out the effect over time. But the point is they kind of seems to me like they were trying to kind of clean the slate a little bit so that these guys could come in, and then next quarter and the quarter after that, it can really start to be based off of their actual performance and their actual changes that they've made in the company. With the CFO announcement, they also announced a cost cutting drive that they're going to be going over for the next couple quarters, and they were saying that they expect to be able to make about 150 million in bottom line savings over time going forward once they finish up with a lot of cost cutting measures that they're trying to do. And then one thing in particular they said is that they were actually looking to reinvest a significant portion of that savings back into their frontline workers. About a third of it, about 50 million of it, they said, which I went and I took that 50 million and then divided it by all the total employee count that they have, which isn't necessarily an accurate way to go about it, but it was just me kind of trying to say is like, okay, well, how much money per hour if we assume that all the workers work like 40-hour work weeks or whatever, does that actually give them? And it's not necessarily the biggest of increases in my opinion, but like I said, it's also very possible that only applies to half of the employees or even 2/3 of the employees, and it's also possible that they work less hours, so that could be really throwing it off. But so it seems to me like it's maybe like a 30 to 50 cent increase on kind of like the bottom line wage thing. But the point is they're trying to decrease their churn and try to get a little bit more people sticking with their program going forward. So point is they're making changes. They're making changes. They're starting to think about ways to turn the ship around. And with their new management team in place, I think they'll finally be able to really focus on that going forward rather than being focused on the actual changeovers themselves, which is one of the things like I had said with the executive changes in PayPal. It says like, I'm going to give them a little bit of a break for this year because they were so focused on turning over their main executives and making the hunt for the right executives, and then also hiring new executives has costs associated with it. That I'm willing to kind of give them a little bit of a break over that factor. So I'm essentially saying the same thing for advanced auto parts a little bit. I'll be happy to see if they do better in the next quarter, but especially in the first quarter, which is where we often see a little bit of a better quarter for them in general. Mr. Beast. Oh, Tyson over? What about Tyson? I don't know if it's over. I'm not sure what you're talking about in particular. I still have them in the portfolio if that's what you're asking, but that's definitely a position that I've been less than satisfied with. And definitely not very happy with how well they perform, but also not super happy with my own valuation estimates of them in the past. And then I've revalued them over time, especially with some of the adjustments I've made to my DCF template over time. So I don't have the greatest of values for them. About 44.36 is what I have right here, and they're currently trading at 48.74. So they're still overvalued. And I believe I said a few weeks ago that I was going to be kind of eyeing that one, really monitoring that particular position and trying to decide whether or not I wanted to hold it going forward. And I'm still holding it, still haven't sold the rest of my position on it, but it's one of those situations where I'm kind of like hoping that maybe they have some good news one day, pop up 5 to 10% over the course of a week or something, and then maybe I would consider getting out. I did, as I also have commented when I was saying those things in the past. Tyson used to be one of my major positions, one of my top positions for a period of time, and I did make some significant gains on that when I brought it down to a much more smaller auxiliary position. So it's one of those ones where I'm down on my current shares, but overall I'm not really down on Tyson on my total investing experience with him as a whole. But the down that I am currently, it does balance out a lot of those gains that I had in the past. So it is almost like a wash position for me at this point. So definitely been a waste of time and capital, perhaps. But yeah, still in the portfolio. Still not very pleased with them, but that is what it is. Mr. Beast also. Who would believe that my mode is number one? Yeah, I mean, I believe that. I believe that. No surprise for me there, especially since you're one of the people that was always pushing me to take a look at it initially back in the day, and then pushing me to look at it again and to keep paying attention to it. So of course, it's a big one for all of us. I mean, it's not one of my top positions yet, but it has the potential to become one of my top positions over time. It's only 2.5% of my portfolio. Keeping in mind that my largest position is only 7.5% itself, so it's about a third of that size. The average position for me is like 3% or something like that. Yeah, oh, or maybe I don't have it on this page. That's right. I think it's on the other page. I always forget that. But yeah, so it's not a huge position for me, but that's because I've been trying to be careful with it, considering I knew that it had the potential to go down a lot, and I am still down 16% on my position for that. So I have the ability to add more to it, but it's also, like I said, 2.6%, where the minimum size holding for it suggested by my allocation system is 3.3%. So I can still buy another 1% of my portfolio into in mode, and it wouldn't really be over allocated. It would only just be barely appropriately allocated. And so I didn't buy any this week, partially because it was kind of having a pretty good week. And so I was kind of trying to see if maybe it would come back a little bit. Currently at 22, still significantly in the kind of downward momentum period. So maybe I should just decide to buy a little bit more this week, and especially before it starts to maybe get up into an uptrend, because at that point, some traders might start coming into it and helping it get back up too. Um, Also, Mr. Beast, I don't know if you saw. Supposedly, there's like maybe some discussions going on between Palestine and Israel about maybe some cooling down of some of the hostilities. Or I was hearing something about maybe the hostages being negotiated for this weekend. It's one of those situations where I'll buy it when I see it, kind of thing. It's one of these I won't necessarily believe that they've really come to an agreement until the hostages are actually released. But one of the other things I've kind of mentioned is that InMode is in a lot of pain right now due to the whole medical equipment situation, but it is also a company that operates in a conflict zone right now. So I definitely think some people sold out of it just for that reason alone too. So whenever that situation starts to cool down a little bit, I definitely think some other people will maybe start to pay attention to it for that reason as well. So we'll see about that. They're trying to take time. Yeah, see, I would definitely buy that. Maybe they're just trying to stall a little bit. Yeah, like I said, I'll believe it when the hostages are actually back home. It's one of those situations where it's like I wouldn't believe anything until we actually see the results of it. But either way, that's InMode has that kind of weighing down on it a little bit too. It's not just the whole medical equipment and weight loss drug concerns and all those other things. But InMode, being that it does operate in Israel, is dealing with those situations as well. While even though, like I've said, that I don't really think that conflict is really going to affect the company really at all. So I think that those concerns are unwarranted, but a lot of other investors, don't really necessarily look at it that way. So anyway, I did want to dive a little bit more into Advanced Auto Parts. I was kind of talking about my feelings about the earnings report before and as you were hopping in, Mr. Beast. But I will go into some of the other details. One of the other things that I didn't mention about the earnings report, one of the better pieces of news, is they also did announce that they're looking to sell the Worldpac portion of their business, which the Worldpac portion of their business is essentially a sections of some of their stores that are relatively larger stores that they have, as well as they're much more focused on distributing and warehousing for a lot of professional mechanic operations. And so what that means is that they end up having relatively high inventory levels, a relatively high capital investment, and also relatively low margins for that section of the business. As I've kind of mentioned in my AAP video, I said that the lower share of DIY as a section of AAP's business is one of the things that drives them having much lower margins than their competitors. So by them trying to essentially sell this section of their business off, which was like it was kind of a strategic purchase back in like 2013, I believe, maybe it was 2014 for the company, and it just seems to me like that never really panned out for too much of a successful expansion for them as a business. And it's been a weight on, I think, on their margins. So they might be able to raise their margins up a little bit by selling this portion of their business off. So of course, it depends on who they sell it to and what type of deal they manage to get for that. And then they also announced that they want to sell off the Canadian section of their business, which I would say is arguable that that creates a little bit of a lower amount of margins for them as well. Not necessarily because of the actual operations of the business, but Canadian consumers typically have a little bit less discretionary income compared to their American counterparts, not by a wide margin, but usually by a little bit. Even though you could also maybe argue that Canada's a certain type of terrain and environment where maybe they would actually have more maintenance needed. So you could argue kind of both directions a little bit on that factor. But one thing that I do say I could say strongly about it is that Canada in general has higher corporate taxes and costs to operating in that region. And so they might be able to lower their tax rates a little bit by essentially getting rid of that Canadian section of their business. And then also, there's also just the further sales, marketing, and administrative costs that would be related to that stuff as well. So by getting rid of the Canadian section of the business and by getting rid of the Worldpac section of their business, they might be able to raise the margins up a little bit going forward. Um, so it's a soul for you. Which one do you mean, Mr. Beast? Which one are you talking about? Are you talking about in mode or AAP? I haven't sold either one. To be clear, I'm just talking about my thinking and feelings on it. Um, but I'm just talking about what AAP was talking about in the earnings report. Are you talking about or are you saying that Yeah, no, I still have AAP. I haven't sold it at all. I'm just talking about the earnings report that they had this week, which was a bit disappointing for a lot of people in the market. So I'm kind of just giving my general thoughts on it. So I did pull up my model here that I built for them that I showed in my video. I have made some adjustments to the actual model itself a little bit. I to try to account for this. I do think maybe I was being a little bit optimistic in terms of just how much of the share of the kind of other category that they'll be able to leech off of going forward in the future relative to some of the stronger players in the industry, that being O'Reilly's and AutoZone. And so I did try to kind of take into account some differences in my thinking about how much share of the total auto retail market that they'll be able to have going forward. But at the same time, I also found that some of the estimates that I made for the auto retail market as a whole to maybe be a little bit on the conservative side. So I actually did up the total market size for auto retail as a whole in my bear, base, and bull cases for this model, but I did lower the actual market share that I think AAP will be able to command, perhaps on a forward basis on the 10-year forward model. I would much rather be conservative on this, and then just readjust my thinking relative to the company now, especially considering, like I said, it's like, it looks like I was perhaps a little bit too bullish in that video. My fair value for the company in the video was like 85 plus, closer to 90, I think, even for the actual fair value that came up for the company. And you guys will see that my fair value now is much closer to the actual share price currently. Still a little bit higher than the current share price, but much lower. So we've readjusted our thinking. And so not just the market share that I think they're going to be command, but I'm also trying to be a little bit more conservative in terms of the margins that I think they'll be able to command as well. So if I come over to the actual valuation template as well, so yeah, I've readjusted my assumptions to be more in line with with the actual adjustments to the valuation I did here. The average between the bear, base, and bull case for the revenues that I came up with in this model was 17.7 billion in 2032, and 17.7 billion is relatively high compared to both the bear and the base case. The base case being about 15.8, 15.9. It's really just being pulled up significantly by a pretty bullish potential if they were to remake significant market share gains in the bullish case. But in the actual valuation, the average between those three bull, base, and bear case outcomes for this one is 16.4. So 17.8, 16.4. You can see that I'm still being conservative even relative to the model in these three cases. But then the expected value, or actually the median value, was 15.1, where the median value in this one was 15.8, 15.9. So I am trying to be a little bit more conservative on that. The expected average, taking the weightings into account, because I'm also weighting a little bit more towards the bearish case than I am towards the bullish case. So I'm trying to be conservative in multiple ways now relative to maybe the estimates I had before. But the expected revenues in 2032 is 15.2 to 15.3 billion. And then I'm trying to allow in the short run the revenue assumptions to essentially just be in line with the analyst estimates. Then coming over to the margins, this is the area where things really changed a lot. I definitely adjusted my margin assumptions quite a bit. I'm trying to be likewise a little bit more leaning towards the bearish case over the bullish case. But at the same time, my long-term margins are basically still in line with what the model was getting to me, about 6, 7, and 8% perhaps in the future. But at the same time, in fact, I think I meant to have this one at 7, not 8. So even in the bull case, I'm trying to be a little bit more on the conservative side of it there. But then in the short run, we're really actually assuming that the next few years of margins are going to be very relatively low. See, like this year, which is in line with the analyst estimates, we're assuming that the operating income will maybe be a little bit over 200 million. But then even in the next couple of years, it's still going to be relatively low margins of 3%, 4%, close to 5%, and then up to 6%, and then over time that will maybe push up towards that 7% level. But much more conservative we're trying to be in terms of the actual estimates for the margins going forward, and then we'll kind of see how that goes. Yeah, I had the 7 there, so did want to have not quite as much leaning on that, especially if I'm going to have the bull case be up to 7. But either way, that brings then the actual expected value up to more like $60 to $61. The median value of like 56 to 56.10. The interquartile range between about $25 and $84 relative to the current share price, which, like I said, is not super much lower than that. We're currently at around $50 per share, so I'm saying it's maybe worth about $60 per share. And then, as I had said before in the video I made, I was saying it was worth more like 85, $88 per share. So yeah, we've really pulled down that number quite a bit compared to where I had it. Hey, I'm not perfect. I make mistakes. It's one of those things. No, I'm not going to make a new video for it. This me talking about it here in the live is the closest you're getting to that, because I like to just move on and talk about other new things and not cover the same companies all of the time. But point is, and I definitely over allocate it too quickly, as I've mentioned many times. But the point is this is where we think the fair value currently is. I wish I hadn't been so over allocated to it, because then maybe I could just be averaging on into it, because as I said, it's still below its fair value, but it's now only at the 46th percentile of that fair value. If you come over to the dashboard, it's you know still pretty high up on the dashboard, just not necessarily the most appealing or most attractive of the options in the dashboard. Yo, Scott, what's up? Um, that's most of my thoughts surrounding AAP. Like I said, I'm happy to see some of the decisions the management is making, but it's definitely going to be an ugly rest of the year. Well, I mean, the ugly part's already past us. I think the fourth quarter will probably be relatively fine. But the point is, the total 2023 numbers, uh, all in, all together, all added up, is probably not going to look super pretty compared to previous years. And I'm hoping that 2024 will start to be a little bit of a better year for them. And this valuation now is as it's put, with the operating margins much more in a lower estimate here in those next 3 years. I definitely think that pushes it more towards a potentially conservative side of things, and I would much rather be surprised a little bit more to the upside on that. So with that, let's see, we're at about an hour. If you guys have maybe some companies that you want to maybe take a look at, we can do a little bit of that before we close out a bit. Don't have necessarily too many to look at. I'm trying to think about what company I want to make a valuation for next. And I obviously have been considering taking further deep looks at Hunting PLC and Tidewater, which are the two companies that I said were potentially the most interesting out of all of the screening ones that I had done, which these are companies in the energy equipment services. I am somewhat trying to look for maybe an oil company to look at as well. But I don't really want to look at a small oil company. So that's the thing, is like, maybe I'm going to take a close look at some of the bigger major oil players, and maybe I'll make a decision to take a closer look at one of them, because I do kind of feel like with the lower oil prices we've seen recently, that maybe it could be a good point to get an oil name, but I really do kind of want a more substantial one if I'm going to do that, because I kind of want them to have a good diversification across assets geographically and all that. But one company I have been heavily considering taking a look at here for maybe my next video, and I've started to kind of like look at the numbers. I saw the 10K was out on the 17th, 2 days ago. I haven't looked at it yet, but I saw that it was out. Is Skyworks. So I maybe that one will actually possibly be the next company I do evaluation on. And also, I kind of wanted to comment that what with me taking a little bit of longer period of time between some of my valuation videos due to being busy with school and stuff, and also I've had some weeks where I've missed my live show being with some technical difficulties. I'm trying to slow down my schedule a little bit, try to take a little bit more time with companies I look at, and not be so quick about it. So I'm not keeping to any sort of a schedule in terms of when I'm going to be putting videos out anymore. It's no longer going to be a 2 week schedule for that. I'll be putting out valuation videos when they're ready. That's basically what I'm going to be doing going forward. I am going to still try to do the live show every week, technology willing, of course. But that is what it is. And obviously, it looks like today uh, worked out pretty well, so no problem there. Scott flying the Chinese flag. Yeah, that's always one of the big concerns about Skyworks. And hopefully, if I do decide to do a video on that one, maybe I will take a pretty close look at some of their customer base as well. Maybe that would be a good section of background information to cover for the company, to maybe allay some of those concerns, or maybe even concentrate on some of those concerns. So I don't know. Is what it is. Making noise. Come on. So, any companies you guys want to take a look at? Anything in particular comes to mind, or maybe we'll look at Tidewater. What was the tickers? Got Hunting and Tidewater. Oh, oh yeah, we were talking a little bit about in mode, and that news that's kind of on the wire a little bit this weekend. Mr. Beast kind of agreed with me that it's one of those situations where we'll believe it when we see it, kind of thing. Um, Twitter news and Twitter rumors or whatever. It's like we'll see it. It's one of those situations where it's like um, one or both parties has some incentive to essentially stall for time a little bit. So making promises like we'll release the hostages, or things like that is like that would be really great for in mode if we get that because like I was also mentioning they're undoubtedly going to be getting some suppression in their stock price due to those concerns. But at the same time, it's like I wouldn't get my hopes up on any actual good news related to that conflict until we really really see it. So hopefully, it'd be really great if we did get some good news on that, but um, I wouldn't necessarily believe it until it really really happens. Kind of the situation there. So anyway, I did pull up Hunting PLC. This one, let's see, Hunting PLC. This was like this one created a bunch of equipment services for energy stuff. I believe a lot of pipe-based technologies, underwater piping, and other pumping technologies as well. Like I said, I have only really kind of started to barely look into this one, but it was just one of the ones that screened really, really well in my screening process. But taking a look at some of the forward estimates, you can see that they're expected to have some growth next year, according to some analysts, and the year after that. Nothing super major compared to some of the bigger gains that they had in 2022 and 2023. But you can also see that that was a little bit of a bounce back from some of the declines that they were seeing prior to that. But EBIT margins expected to be a little bit stronger in these few years as well, relative to a little bit of a shaky margin experience. It looks like, at least according to the estimates, if we were to bounce over to the financials themselves and the ratios, and we'll open gross margins and EBIT margins. I look what their history is actually like. So yeah, the gross margins have ebb and flow pretty significantly. I would be curious to see what was happening in their history in 2015, 2016. But then they've also had some negative margins as a result of that, negative 3% in 2015, negative 28% in 2016, back to negative 2% or so in 2017, negative again in 2020 and 2021. So yeah, it looks like their margins is a bit on the shaky side, which could make them way less of an appealing company to take a look at for me in particular, perhaps. But like I said, just going off of screening stuff, so it's not really till you start to really dive into it that you see whether or not the company is actually worth it or not. But who knows? Maybe that's a scaling issue. Maybe they've spun off sections of their business in this period of time to make them a little bit better going forward. But yeah, just on that quick cursory look, it starts to make them look less appealing. And then taking a look at valuation, EBIT margin, and the EBIT ratio as well as the PE ratio, definitely a whole lot of mess going on there in 2020, 21. But I mean, lots of companies had that kind of stuff going on. Kind of narrow in on the most recent year or so to kind of focus away from some of that mess. You can see that kind of on average, they've been trading in like the teens kind of range. They seem to be a bit low relative to that average, but that average does include some higher levels here, which might include some suppressed earnings. We kind of scroll back to maybe this period here where they had a little bit more of a reasonable stretch with no unprofitable quarters in there. Then you can start to see maybe a little bit still kind of in the teens category, but we still had periods of time where it was at a bit lower levels. So interesting to see that as well. Likewise in the back, but definitely a very shaky earnings history. So yeah, just like that alone, it starts to make the screening process not make them. And the screening process made them look good, but here just taking a look at some of the history, not just the most recent figures, the history of the numbers, and then suddenly they start looking maybe way less appealing already, just like that. Um, let's go look at maybe the other one that I was looking at, Tidewater. If I'm remembering correctly, this one provides water and chemical services for those energy companies as well. So a lot of like spraying water services for a lot of like the fracking companies, as well as other chemical delivery and removal services. That's one of the other parts too. It's not just about getting water in there, but it's also pulling the water out so they can keep doing the digging process. A lot of like pumping equipment and stuff like that as well. So let's like look at this one a little bit. Normally I try to look at the valuation stuff afterwards, but I'm already at the page. They had some shaky earnings periods as well, it looks like, but a little bit less of it. Their history here only goes back to 2018 as a public stock, at least on this chart. So that's interesting to see. But if we just narrow in away from that, still have a whole bunch of period there. So narrowing in on some areas where they were a little bit more reasonable. Oh no, this is kind of all negative multiples for that region right there. It looks like maybe only in the recent year or so that they've actually had maybe an appropriate multiple, which is again not good. Doesn't make it look super great. But is what it is. So yeah, even just like that, just like that, the two companies I thought maybe looked a little bit more appealing than some of the other companies in the screening process. Just like that, they started to look way less appealing. So I don't know. Maybe it looks like Skyworks might be the one to look at in the short run. But like I said, we'll see what my model comes up with. We'll see how maybe looking at their customers looks like, and maybe I'll come up with something different. But I very much would appreciate if some people have some ideas for companies that maybe I could take a look at. No guarantees that I do look at them, but I am looking for suggestions going forward and stuff like that. As I said, maybe I'm going to take a brief look at some of the oil majors and maybe take a look at one of them or something just because of my own interest or not. But yeah, maybe I think that might do it for today though. So it's an hour 15. I don't necessarily want to go super long today. I've had some long shows in the past, but I have some other stuff I want to get to. Um, XOM insiders buying. That could be good. That could be good. Um, RGR. Want to take a look at RGR? Yeah, I know you were late. And I'm also have I'm still on that slightly earlier schedule because of daylight savings as well. So I haven't decided to push the show a year or an hour later yet or anything at this point. But yeah, we'll look at this one real quick, but then I probably am gonna go. So yeah, looks like I don't have too many estimates. I only really have estimates for next year, which is interesting. I guess they don't have a whole lot of coverage for 2025 or anything, but they're expected to at least stabilize the revenues next year, start to grow a little bit. And then it looks like they're expected to have slightly better margins as well. But considering they had pretty significant decreases in their operating income, that's to be hoped for, I guess, at some point. Looking at the valuation, I've obviously, as I've said, like I like Smith and Wesson as a brand a little bit better than Ruger or Sturm. But they're pretty significant market share, very similar levels of market share compared to um oh Roger. Okay, yeah, I saw it's RGR. I'm like Ruger. I thought it was kind of an odd one for you to suggest. Roger. OLN. I was looking a little bit at OLN after we were chatting about it. It is definitely not super cheap. That's for sure. You were right about that. It's definitely been running a bit. Like look at the. I mean, not super cheap compared to like what it's been at. So it's one of these things where it's hard to judge it necessarily, but um, it could be good to look at. I'm interested in the company as a company. I'm just not sure necessarily where the valuation is gonna shake out because right now it's in kind of the mid-teens, which isn't super expensive, but if you look at it, it's very often traded at lower multiples. This is the last couple of years, so obviously that's maybe being a little bit rude to it. But if we scoot back a bit here, you can see that yeah, it's traded at 12, 15 as an average over 2014 through 2019. So it's kind of in like an average of its kind of historic range, and then this had obviously lower interest rates. So if we're adjusting for interest rates, then the most recent levels of like 13 to 17 to 18 kind of make it seem like it's maybe about fairly valued. I wouldn't like I said, I wouldn't necessarily call it pricey, but it's definitely one of the things where you probably would want to get it real cheap, especially since it's a chemical company. But I am interested in it as a company, and like I said, I did find that podcast that there is an episode on for the company, so I did kind of want to give that a listen, maybe take a look at it. But I figure the company also might be a bit complicated in terms of thinking about how the chemicals are applied, so it might not necessarily be the easiest evaluations to build. But I am interested in it. I might be taking a look at it. It's been kind of on the back burner for a long while. I just definitely feel like Skyworks would be an easier one to build a robust model for, and also it probably would get better clicks too. So it's one of those situations too. Um, I saw a chart on copper going around on Twitter. I have to send it to you. Yeah, definitely do. Um, I did comment a little bit on how we've been talking about Encore and Wire. I definitely was talking about that a little bit. I was trying to incentivize people to maybe join us in the voice chat a little bit more. Mostly just you and me that talk in the voice chat. But I was trying to say, hey, guys, you don't just have to join the Discord. You could also hop in the chat and or even message me to come talk to you in the chat at some point. But most people don't take too much advantage of that. So, is what it is. But yeah, I mean, Skyworks, Olin, those are probably two companies I'm a bit more interested in maybe taking a look at in the short run. Beyond that, kind of like I said, hoping that Encore drops. We're hoping to get Encore at cheaper prices. I kind of hope that Schwab drops so that maybe I can get it at cheaper prices. I know you don't want to see Schwab drop, but me as somebody who doesn't own them, I would maybe like to see them drop if that was going to be the case for it. Um, Update my portfolio on the channel too. Yeah, I mean, I could. I kind of stopped doing that a while ago, and that's partially just because I update it every week here. So that's one of the reasons I usually don't participate when people drop their portfolio pies in the Discord. But maybe I will do that. There's nothing wrong with showing it in multiple places. Some people are in the Discord and chat in the Discord, but don't show up to the live shows all the time too. So it might seem like I'm ignoring them in that sense, but I partially I because like I used to not show my portfolio every week. I used to kind of do it more like every quarter or something on YouTube. And then but when I started doing it every week was kind of when I stopped talking about my portfolio so much in the Discord. But there's nothing necessarily like I can't do both. But oh, okay, you mean others in general. But still, I mean, if I did it more, maybe it would help push other people to do it more too. So it's one of those things. Uh, where both can be true. But yeah, so I guess that'll probably be it for today. Like I said, look forward to next week's live show. Hopefully, my computer will continue to work and not be a total pain in the ass on that front. I am still hoping to build a new computer at some point in the near future. I've been putting that off for far too long, but I will be diving into those Skyworks reports this week. So we'll see what comes of that. As I said, it'll be done when it's done, and a video will come out whenever it's ready, not when on a schedule. But who knows? It very well might be Skyworks, and it might be within the next couple weeks. So please like the stream if you haven't already on your way out, whether you're watching live or on the replay. Please subscribe to the channel if you're not already. Please hit that notification bell. Join the free Discord. The link is in the description below. It's in the pinned comment in the chat and all that. And if for some reason anybody out there wants to help with the potential new computer process, PayPal links exist out there too. I usually don't try to push that stuff too much, but some of my viewers tell me that I should push that stuff more. So if anybody feels like adding to the new computer fund to make sure that my work continue comes out on a timely basis for you guys, that would definitely help with that. So, all right, I'll catch you all next week in the next live show.